Hey guys, this is Dave with Moniology. Hope everyone is having a great weekend. This is the weekly market review for September 16th and 17th, 2017. We're going to take a look at some of the weekly charts in some of the most important sectors in the market. Okay, so starting off with the S&P 500, this is the weekly chart here, as are all of these charts. And what we see here is that we broke out to new highs on a closing price level last week, which is on the one hand very bullish, but we're still very skeptical of this particular rally. Why? Because we're seeing some pretty significant divergence here to even the last high. But so in other words, when we broke out to from 2400, we had negative divergence. Then we broke out to about 2450, we had negative divergence, and now we're breaking out of 2500 and there's negative divergence. This may end very, very badly, but until things price actually reverses to the other direction, to the downside, and breaks below the weekly Bollinger Band here around about 2440, frankly, we're still in a bull trend and there's no reason to be short. But we were skeptical of this particular latest snapback rally and wouldn't be surprised to see some sort of pullback, and eventually that'll turn into a larger correction. But until then, if you're long, stay long and keep your stop losses very tight. Next on the list is Nasdaq, and similar to the S&P, we're about to break to all-time highs here again, and we're consolidating right below that 6450 area. But again, look at this divergence on RSI. That's a very, very bearish longer-term indicator, and unless that's broken out to the upside to create new momentum in the next coming weeks, we think that ultimately this rally will break to the downside. The Russell 2000, well, you want to in a bullish market environment, you want to see the small caps lead the large caps, and this particular bounce back has not been the case. So the Russell, while it's done well over the last couple of weeks, it's acting much weaker than the two larger indices, and in the Nasdaq and the S&P. And here again, you've got negative divergence, and ultimately we think that this is going to break to the downside. Then now you've got the MSCI World Index. This one has been in a very bullish trend since, well, basically in all of 17, and really since the January of 2016. Broke down from this uptrend, and now it's starting to kind of recapture, and that's what we wanted to see. I mean, from our perspective, the best risk reward in the actual equity markets is in the world index and international markets, especially emerging markets relative to domestic and international markets. But here again, we're seeing divergence. One weaker lower high, another lower high, and now another lower high. So unless we can kind of retake those RSI levels, extremely overbought levels, I might add, I think ultimately this is going to close at some point in the coming couple weeks. It's going to break below that 70 point on the weekly RSI, and that's going to mark the beginning of what we believe will be a pretty significant correction. The VIX Volatility Index weekly chart here, it's still in this bullish flag formation, but every time it tries to bounce and every time it tries to break out of this pattern, it breaks lower. And so until it does, bulls are in control. The U.S. dollar, one that we've been very bearish on since around that 104 area. We thought there was significant weakness. So why do we think that? Well, similar to what we saw in the S&P chart, where we saw resistance, rather negative divergence in RSI, which led us to believe that likely next direction would be to the downside. Well, so too with the U.S. dollar. When we were hitting new highs in price here, we were seeing some substantial divergence in negative divergence in the actual price pattern. So that led us to believe that this was going to be the start of potential new corrective wave to the downside, and sure enough, we saw a fairly nasty decline, and who knows? I mean, we're still in this downtrend. We might bounce a little bit, but it seems like every bounce is met with additional selling, and ultimately our price target is closer to that 82 to 84 point, and this is a longer term perspective, so we wouldn't be surprised if we potentially try to take out the weekly middle Bollinger Band around 95, the 50 EMA around 97, 96.50. But ultimately, this is downward sloping, and we think it's going to head down this way. But if you look at a long-term perspective, and it's for discussion outside of the scope of this video, we think that the dollar ultimately does go to 120. But in the next couple of months and possibly years, I think 82 to 84 is a reasonable price target before it churns up and starts moving higher to the upside. Next on the list is the 10-year U.S. Treasury. We've been pointing out that yields are in a new bull market. Now, this might take a long time to play out, but what's fairly clear to us is that this downtrend since 2000, basically middle of 2013, has ended. We've broken out very, very strongly. Now we're consolidating in this bullish flag formation, and we found support here, not surprisingly, around that 2050 level. Beautiful hammer pattern, and now we're making a run to test that 50 on the weekly RSI. Should we break above that 50 this week, we expect that this bullish flag pattern will actually be broken to the upside, which would be a very bullish development for inflation and yields, but very bearish development for any fixed income instruments. The tip to TLT ratio, this is a ratio that really tracks inflation, and you see it's got a similar bullish flag formation, but we're at the top edge of this particular bullish pattern, and with the MACDs starting to curl close to zero, we think that inflation is really going to start to gain steam in the coming weeks and months, and the market, frankly, or the media simply just does not talk about this, but this is one of the reasons that precious metals have been doing very well. But you're going to see this in the next couple of charts between oil and gold. There's a lot of underlying currents that suggest that inflation is definitely rearing its head and coming in full force in the coming months ahead. So gold weekly, as you see here, it's broken out of this bearish downtrend since 2016. Rather, it's not a bearish downtrend, but this kind of consolidation pattern since 2016. We broke out and almost kind of double topped here for a little bit around 1362, and now we're probably going to retrace to that 1300 level, possibly even retest this breakout of the trend line around that 2070 area to shake some weekends out, get rid of some of these overbought conditions. If 60 level on the RSI cannot hold, then likely that retest level is going to be met with support around that 50 on the weekly RSI. Crude oil, we've been very bullish on crude oil since this breakout from this downtrend on the RSI level in June, and it's taken some time, but finally we're seeing this break above 50. We think that that's going to happen this week, and a run towards 55 is in the cards. You're going to have a lot of resistance here, and we don't really know how long it's going to take. But ultimately, when you're looking at the monthly chart, we see this basically a inverse head and shoulders pattern here that's developed, and this breakout will happen to the upside at some point in the future, and there are going to be some great opportunities in crude oil. Finally on the list is the high yield bond ETF, JNK, another one that gives us reason for skepticism, and that this latest rally in the markets is not for real. Why do we say that? Well, this bearish wedge was broken down pretty dramatically to the downside. We found support, really no surprise, on this weekly Bollinger Band, and now we're retesting this breakdown point from the downside with, again, negative divergence. So if this line around that about 37.50, if that cannot be broken to the upside, then we believe that next move, substantial move, is going to be to the downside. And since this particular ETF reflects credit in the markets, it would therefore coincide with a likely correction in the markets. But overall, the general theme is equity markets are still in a bullish uptrend, and but they are showing some significant divergences on the weekly charts, which suggests that there's potential downside in the not too distant future. Commodities are starting to perk up. Inflation is starting to perk up, and you probably want to reduce your exposure to fixed income. If you're trading those markets, you probably don't want to be in those markets to the long side. Guys, thank you for watching. Please follow us on StockTwits at Moniology, Twitter at Moniology, and please subscribe to our videos. Have a wonderful week.